Is now the time to be investing in Chinese equities? That's an article that Franklin Templeton released in January of 2022. And it's been half a year since that article has come out. And I wanted to review the article, the major points, see where they are right, see where they are wrong, and assess if now is the time to purchase Chinese equities. So that's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel. And here's the article that I was talking about in the intro. So this article came out in January 13th of this year, and it's titled, Is it now time to consider Chinese equities? And they concluded by saying that the answer isn't that simple, but later on they'll show you how they're leaning on no as opposed to yes. And so here's where I mean that they said no. So they concluded in this article that we believe that the short answer to the question is no, but as with most things, it's not a simple answer. But so far in 2022, give credit where credit is deserved, they have been correct, albeit I have shown you on this channel where there are still ways to make money with investing in Chinese securities. One of the ways was with selling a cash secured put on Alibaba. Unless you believe that Alibaba's share price will sustainably go under $70 per share over the medium term, that's a winning investment. And if you haven't seen that video, just search double down on Alibaba to see how you could still make money. And that was a profitable investment opportunity that I made thus far in 2022. So you can make money on Chinese equities, but overall, just buying and holding hasn't really worked out for a lot of people thus far in 2022. Now, here's why they believed that the outlook remained negative, and that is that they felt their pessimistic stance because there were still regulatory clampdowns, which showed at the time few signs of abating. The property sector was weak, and it still remains weak to this point. Leverage looked elevated across much of the Chinese private sector, from banks to housing related names to broader state-owned enterprises, and that leverage is only increasing in my opinion. Relationships with Western nations remained frayed. I would say that this is maybe like a 50-50. Some relationships have gotten better, but others haven't. The dollar strength on the back of the accelerated Federal Reserve tapering has potential to weigh on returns, and it absolutely has. And in fact, a lot of companies are reporting translation adjustments where it's showing weaker results, like for example, Starbucks Q2 earnings. And then of course, elevated commodity prices, which of course would impact input costs for Chinese manufacturers and of course could reduce their competitiveness. Now, the only risk that I believe that they missed here, because none of us actually thought it would be a significant issue in 2022. Even myself, even though I talked about this risk a lot, I didn't think that it was realistically going to be a huge risk or as big of a risk as it became in 2022, was the persistence of the zero COVID measures. And it actually became the largest overhang. So I do have to fess up to you guys. Although I did talk about it a lot, I personally didn't think that it would be as bad of a situation as it turned out to be in 2022. None of us did. And so from here, you can see in this article, they sort of gave you sort of like a seesaw, I guess, of showing where they fall. So there's some reasons why they're bullish. So of course, the valuations remain depressed and they likely won't recover until domestic growth picks up. So that's a good. The second part is like a contrarian level of sentiment. Like institutions are not even buying the name anymore. So there was a lot of contrarian sentiment there. The other sort of bullish item was the fact that we all at the beginning of the year did believe that there could be central bank stimulus or sort of like helping the consumer in some way or shape. But I don't think that really happened. Instead, the CCP just gave up on their 5.5% GDP growth target. Now, they did reduce interest rates, so that has been a plus, but overall, there hasn't been much from there. Now, in terms of global growth, Franklin Templeton did say that that was a potential bullish item. Well, I think most economies are going backwards. I mean, the US is in a recession technically, even though if their administration doesn't want to admit it right now, but they will admit it in Q3, that's for sure. And then of course, the largest overhang was domestic growth. And the reason why domestic growth was such a large overhang was because they continued with their zero COVID policies, which of course caused the economy to not grow at the level that it was expected to grow at. And so I think in Q2, the economy only grew at 0.4%. So that's the lowest level in many, many years. So for the most part, they were right. Now, here's what they were saying that could sway their position. Now, first, they do believe that because there's a meaningful election happening in China this year, the common prosperity approach remains a fiscal point, and that could be a policy that would accelerate sort of growth. But I do have to say that part of the reason why common prosperity is fading is that the policies that were enacted with the common prosperity in mind spooked business owners and slowed growth when President Xi needs China's economies to stay at least robust. So he's preparing for political meetings that are expected to return him for a third year in power later this year. And so you can't continue on with these common prosperity principles, which were bringing the economy backwards. So economists and scholars say that it's also becoming clear that common prosperity goals can't be met without more drastic and potentially painful changes that Xi does not appear willing to do. So in other words, Franklin Templeton was saying at the beginning of the year that this focus on common prosperity was potentially a good thing, or at least in my opinion, that's how I interpreted it, but it actually ended up not being good for the economy as a whole. But remember, when they did announce those common prosperity measures and Alibaba announced an investment and so did Tencent, I actually dived deep into that Alibaba investment, and really what it ended up being was just an investment into growing their own business in guise of common prosperity. So it wasn't anything from my perspective anyways. And here's an article that came out subsequent to the January article put out by Franklin Templeton. So you can see here that common prosperity was everywhere at the beginning of the year, but now it's backed off. And like I always say, you cannot have economic growth if you go after the wealthy. And China learned that the hard way in 2022. So they backed off their regulatory clampdown, but not before creating severe distrust in the investment community. At the end of the day, if investors are spooked, they're going to reallocate their capital. And if the companies are spooked, then they're going to start allocating capital in a more efficient way. Look, Alibaba did a lot of share buybacks. If the common prosperity wasn't announced, the question is, would Alibaba have bought back as much shares, or would they have invested some of that capital into their business? We never know, but I suspect that they wouldn't have bought back as much shares as they would see more opportunities. But the CCP was going after them for two reasons. One, common prosperity, but two, anti-monopoly. So does Alibaba really want to invest in areas where they already have such a stronghold? May not necessarily be the move. So, of course, that results with less hiring and more money being paid out to shareholders. Now, another item that Franklin Templeton did say could sway their position was that consumption remained strong. It really showed resilience in China, and they pointed out to the China Manufacturers Purchasing Index. It rose above 50 earlier in this year. However, I do have to note that the zero COVID policies created an environment where the Purchasers Managers Index actually dropped below 50, which signaled a contraction. And this is what I mean. So the zero COVID policies have been causing havoc in 2022. So in January, the Purchasing Managers Index actually went down, but Franklin Templeton didn't know about that at the time because this comes out after the end of January. But then notice that those zero COVID policies pushed the Purchasing Managers Index down in 3 months in the subsequent months throughout the year. Now, even in June, it did recover pretty significantly, but then further zero COVID policy measures brought it back down again. Now, we're having growth slowdowns in the Western world, and I wonder if that brings this measure down once again to a contraction level. So from the article, you can see that even super sophisticated people who have access to all the research and resources possible still missed certain things. And that's kind of the whole thing about investing. You really have to pay attention and do as much work as you can. And you can't rely on the experts because even the experts can miss things. And that's just the nature of the game. And so that's why I focus so much on margin of safety with my valuations. And that's why I also value companies at a very conservative basis, because I know that that's my bailout for ignorance, and it has bailed me out in many situations. But the question is, how should we be valuing Alibaba and building out our models with all of the stuff that's happened or transpired throughout 2022? Well, you can see here that overall, Alibaba, the golden goose in China, is expected to have a rough fiscal year 2023. However, over the medium term to long term, I think the business is expected to recover, likely to levels much higher than what I'm forecasting here. So I'm being very conservative. You can see that total China commerce, I'm only growing out at 10% a year into the long term. International commerce, same thing. I'm only growing cloud at 15%. I do believe that cloud can grow much higher than 15%. So overall, I'm just growing revenues at approximately 10% a year. So there's a lot of pessimism built into my valuation here. Now, before I go into my valuation, I do want to point something out to you guys. Note, guys, that approximately 80% of the watch time is coming from people that are not subscribed to this channel. So please, if you have a second, please consider subscribing to this channel so that you don't miss out on any great content. Now, here's my valuation net of the forecasted stock-based compensation that I expect to be paid out. Using a terminal multiple of 20 times earnings, which may actually be low for Alibaba, I'm valuing this company at approximately $300 per share. And at the current share price of $94 per share, Alibaba is the cheapest opportunity on the trackers that the Patreons have access to, as it's trading at approximately a third of its intrinsic value. This is why I doubled down on the company. And if the share price declines to under $80 per share, and I can purchase it using a cash secured put at a price of like net $60, net $50 per share, I'm absolutely going to triple or maybe even quadruple down on this name. Now, how do you get access to the model? Well, you can get access to the model at the lower tier of the Patreon. And if you want to join us for a live epic presentation, you can join us at the upper tier of the Patreons. Now, one interesting thing that I do want to point out is although I remain bullish on Alibaba, at least this particular company on its own, I do have to note that Ray Dalio looks to have just exited his Alibaba position. And I actually talk about that in this video right here.